For a decade, the animal health sector has operated on what you might call the rubber band theory of pricing power.
Oh, I like that, where
Yeah.
you just keep stretching the price.
Right, exactly. You just keep stretching the price of veterinary care,
Yeah.
quarter after quarter, year after year. And the assumption was that the pet owner would just absorb the tension.
Right, because they love their dog. Because they basically view that animal as a child.
Yeah, exactly. The human-animal bond was treated as this, unshakable, recession-proof force of nature. But, when you stretch a rubber band far enough or long enough,
It snaps back. And
Yeah.
it snaps back hard.
it really does.
We are looking at a market right now where that tension has finally, reached its physical limit. Consumers are just exhausted.
Coolly exhausted.
The macroeconomic pressure is compounding, and that historical immunity to inflation we always talk about, it's breaking down in real time.
It really is. So welcome to this Talk Tickers Deep Dive. Our objective today is laser-focused and purely data-driven for you guys.
No fluff today.
None. We are putting the Q1 2026 earnings call of Zoetis, Inc. Ticker symbol ZTS, right under the microscope.
The absolute heavyweight in animal health.
The global heavyweight. They are a historic darling of Wall Street and really the ultimate proxy for this entire industry.
Yeah, if you want to know what's happening with pets, you look at Zoetis.
Exactly. So we are going straight into the numbers, translating all that corporate jargon into plain language, and giving you an actionable analysis of what this actually means for your portfolio.
Right. We need to figure out if that rubber band has permanently snapped.
Yeah, and if the premium valuation this company enjoys is still justified.
Well, to determine that, you really have to look past the carefully curated narrative of their press release.
Oh, for sure.
Because, earnings reports are basically exercises in psychological anchoring. Management teams always lead with the metrics that paint the most stable picture.
Right, because they know the algorithms are watching.
Exactly. They know full well that automated trading algorithms and headline skimming investors will react to the top line numbers long before they dig into the footnotes.
Which brings us to the headline numbers they actually printed. Let's look at the top line results first.
Let's do it.
Zoetis reported organic operational revenue growth of 0%, completely flat.
0. Yeah.
And adjusted net income grew a microscopic 1%.
Yeah.
For a company that Wall Street traditionally prices as a high growth premium compounder, 0% top line growth is a pretty jarring number to see on a terminal.
It's definitely not what you want to see. But, here is the hook that caught the market's attention.
Right.
They simultaneously reported that adjusted diluted earnings per share, so EPS, grew 7%.
Which sounds great.
It does. It landed at the higher end of their guidance. But that 7% EPS growth is doing a tremendous amount of heavy lifting for the stock's narrative right now.
Oh, completely. Because a retail investor glancing at their brokerage app sees, EPS up 7% and assumes management is just brilliantly navigating a tough environment.
Right. They think they're protecting margins and driving bottom line value.
Exactly. But reading the actual earnings transcript
Yeah.
reveals the mechanics behind that number, doesn't it?
Yeah, it really does. CFO Whitney Joseph explicitly noted that 3% of that EPS benefit, so nearly half of the total growth, came purely from convertible debt-funded share repurchases.
I want to pause and play forensic accountant here for a second, because the mechanics of this mover are vital for you to understand if you hold this stock.
It's a very specific piece of financial engineering.
Right. So Zoetis is essentially issuing debt borrowing money that has the option to be converted into equity later. And they are using the cash from that borrowed money to buy back their own shares on the open market.
Exactly.
By reducing the total number of shares outstanding, the earnings they do make are just divided by a smaller number. The pie isn't getting any bigger.
No, they are just slicing it into fewer, slightly larger pieces.
Right.
And the leverage dynamic there is key, right? They are taking on a liability to artificially inflate a per share metric.
Exactly. It's not an organic operational triumph.
No, not at all. It doesn't mean the underlying business of selling vaccines and dermatology medications is wildly profitable this quarter. It simply means they pulled a classic Wall Street capital allocation lever.
Okay, I'll push back slightly though, because, using debt to buy back stock isn't inherently malicious, right?
Not inherently, no.
Like if management genuinely believes the stock is undervalued and the cost of the convertible debt is lower than their cost of equity, it can be a shrewd way to return value to shareholders while they wait for the operational environment to improve.
Shrewd capital allocation, sure, perhaps, but it obscures the actual operational momentum of the core business.
Fair point.
I mean, you are buying an animal health company for its ability to sell animal health products, right? Not for its Treasury Department's ability to run interest rate arbitrage on its own equity.
Right.
When you strip away the financial engineering, the core operational engine is basically stalling. And if you think the EPS number requires an asterisk, the revenue number requires a magnifying glass.
Oh boy, yes. The massive caveat of the quarter, the smoking gun buried right there in the transcript.
Yeah.
Management spent a significant portion of the call discussing a, quote, fiscal year alignment for their international subsidiaries.
Which is always a fun phrase.
Oh, yeah. This was framed as an administrative effort to match up the reporting calendars of their global offices, just ensuring everyone is closing the books on the exact same dates.
Right, and as a result of this quote-unquote administrative alignment, they pulled a massive chunk of revenue forward.
Huge.
They shifted $100 million of revenue into Q1 2026, just pulling it out of the previous calendar year.
Again, I want to play devil's advocate here. Aligning fiscal calendars across dozens of international subsidiaries is standard corporate housekeeping. Multinationals do this all the time to streamline audit.
Sure, they do.
So are we certain they are intentionally using this to mask a decline? Or is this just a messy byproduct of a necessary accounting fix?
Honestly, intent is totally irrelevant to the math.
Okay, that's fair.
Whether it was a deliberate smokescreen or a genuine administrative necessity, the impact on the financial baseline is identical. You have to evaluate the math.
Right.
They reported flat organic operational revenue for the entire globe, 0%. But that 0% baseline includes this artificial $100 million injection that simply shifted from one time bucket to another.
Right. So to see how the business actually performed in the real world between January and March, like how many units of medicine they actually sold to real customers, you must subtract that accounting shift.
Exactly.
And when you run that calculation, the real number is brutal.
Oh, it's ugly.
If you back out that $100 million alignment, global organic operational revenue actually contracted by 5%.
A 5% decline. From the illusion of quote-unquote flat and stable to an undeniable contraction in the core business of the global leader in animal health.
Yeah, that's rough.
I mean, you are currently paying a premium multiple for a growth stock that is actively shrinking.
Wow. So to understand exactly why the business is contracting, we have to look at the massive divergence occurring within their portfolio, right?
Yeah, it's totally split.
This quarter is a stark tale of two entirely different business segments moving in completely opposite directions. Let's start with the bright spot, because it is basically the only thing keeping the consolidated numbers from completely falling apart.
Right.
The international and livestock segments actually delivered phenomenal results.
They really did. The livestock portfolio posted 12% organic operational revenue growth.
12%.
Yeah. In the current macroeconomic environment, generating double-digit growth in agricultural commodities is a massive achievement.
It totally flips the historical narrative, doesn't it?
Mm-hmm.
Because we normally think of the livestock business, cattle, swine, poultry, as this highly cyclical, volatile, commodity-driven segment.
Right, because it relies on weather, feed prices, export tariffs, all of that.
Exactly. Meanwhile, companion animal, the dogs and cats, is supposed to be the steady, premium, recession-proof grower. Mm-hmm. But right now, the roles are completely reversed. The livestock segment is carrying the company.
It is. And the drivers behind that 12% growth are rooted in fundamental agricultural economics.
Okay, break that down for us.
First, you have sustained, robust global demand for animal protein. Global populations are still consuming meat at high rates, which keeps the underlying foundation of the market very healthy.
Right.
But more specifically, producer economics have improved drastically, particularly in the cattle markets.
Let's dig into those cattle economics, because it dictates spending at the farm level, right?
Yeah.
We've seen a massive contraction in the U.S. cattle herd over the last few years due to severe droughts in the Midwest and high feed costs.
Exactly. And when the supply of cattle shrinks, what happens?
The price of beef skyrockets.
Right. So for the ranchers who do have healthy herds right now, the value of a single calf is at historic highs.
Wow. That changes the entire return on investment calculation for a rancher, doesn't it?
Completely. When cattle prices are depressed, a rancher might skip a premium preventative treatment to save a few dollars per head.
Sure, that makes sense.
But when a healthy cow is a premium payout and a sick cow represents a massive loss of potential revenue, the rancher has abundant capital to invest in herd health.
So they buy the premium vaccines, the premium anti-infectives, and the premium productivity treatments from Zoetis.
Exactly. The ROI on veterinary care is simply too high for them to pinch pennies right now.
That makes total sense. And the transcript also highlighted severe disease outbreaks driving a surge in vaccine adoption, specifically in the poultry sector.
Yeah, avian influenza has been devastating flocks globally. And when a highly pathogenic strain of avian flu sweeps through a region, the standard protocol is usually mass culling of the flock, which is economically devastating for the producer.
Old nightmare scenario.
Right. So to mitigate that existential risk, the adoption of preventative vaccines skyrockets. The threat of a regional outbreak reinforces the necessity of prevention over treatment, and Zoetis is perfectly positioned to capture that panic-driven demand.
So between the highly profitable cattle ranchers and the high vaccine demand in poultry, the livestock segment acted as a massive shock absorber for the company.
Exactly. The diversified portfolio did exactly what it was designed to do. But that shock absorber wasn't enough to mask the disaster unfolding in their core domestic market.
The crown jewel, U.S. companion animal.
Right.
It is the high-margin, innovation-driven engine that justifies their entire valuation multiple. And this quarter, U.S. companion animal revenue fell off an absolute cliff, declining 11%.
An 11% drop. I mean, a double-digit decline in your most lucrative foundational market is a blaring red siren for any investor.
Oh, absolutely.
CEO Kristen Peck outlined the drivers behind this collapse on the call, describing a convergence of severe headwinds. It wasn't an isolated failure. It was basically 4 distinct, powerful forces hitting the U.S. veterinary clinic simultaneously.
We need to dissect each of these 4 forces because this is really the core of the actionable analysis for you today. Force number 1 is what we're calling the death of price insensitivity.
Right back to the rubber band metaphor.
Exactly. For the last 5 to 7 years, we have seen cumulative compounding price hikes at the vet clinic. The cost of a routine wellness visit, the core vaccinations, the monthly preventative medications, everything has gotten substantially more expensive, far outpacing standard core inflation.
Yeah, the end consumer, the pet owner, is just fundamentally exhausted. You can only raise the price of dog medicine by like 6 to 8% annually for so many years before the average middle-class family hits a breaking point. They are pushing back. They are actively demonstrating softer demand for the premium, preventative, and chronic care products where Zoetis historically dominates.
And it manifests in very specific behaviors at the clinic level, right? A family comes in, they see the estimate for the yearly blood work, the vaccines, and a 6-month supply of flea and tick medication. And instead of just handing over the credit card like they did in, say, 2021,
We start negotiating.
yes, they ask, can we stretch this dose? Can we skip the blood work this year? Can we switch to a cheaper generic version?
And this inflation fatigue feeds directly into the second destructive force, lower traffic.
Right.
Visit volumes are structurally contracting. Overall, clinic revenue broadly grew about 3% in the quarter, but that growth was entirely an illusion created by price increases.
So actual foot traffic, the physical volume of pets walking through the clinic doors declined by 3%.
Yeah, exactly. Now, management tried to cushion this by pointing to severe winter storms in Q1, noting that blizzards physically kept people away from their appointments.
Which, sure, weather always plays a minor role in Q1.
Right.
But a 3% contraction in foot traffic across the board,
Yeah.
that's structural.
Right.
And it creates a highly toxic, vicious cycle for volume-based businesses.
It really does. The clinics are basically attempting to mask their own shrinking patient base by heavily jacking up prices on the remaining loyal clients who still walk through the door.
Which is a terrible strategy.
It is, because raising prices on an already exhausted consumer base only accelerates the inflation fatigue and drives even more people away.
It's a localized hyperinflationary loop within the veterinary ecosystem. And while Zoetis is trying to navigate shrinking foot traffic and angry consumers, they're getting slammed by force number 3,
Yeah.
vicious competition.
Yeah, rivals see the blood in the water and they are moving in aggressively.
Zoetis has historically enjoyed a wide economic moat built on first-mover advantage and superior science. But that moat is being heavily breached right now.
Competitors are launching direct alternatives in Zoetis' most critical therapeutic areas, specifically dermatology and parasiticides.
Right.
And they are using ruthless discounting to steal market share.
Let's look at the specific brand data from the transcript on this. The dermatology portfolio is the absolute powerhouse of Zoetis. It includes blockbuster drugs like Epoquel and Cytopoint.
Right, the cash cows.
Exactly. Epoquel is a daily oral pill that blocks the neural pathways that cause itching in dogs, while Cytopoint is a biological injection, a monoclonal antibody, that neutralizes the itch-inducing protein for weeks at a time.
It's amazing science.
It is. This portfolio is the gold standard. Yet, U.S. dermatology revenue declined a staggering 13%.
A 13% drop in your flagship franchise is catastrophic. I mean, Epoquel is losing meaningful share because competitors have finally brought alternative J inhibitors, the exact same class of drug, to the market.
Right.
But instead of trying to compete on brand prestige, these new entrants are coming in with heavy promotional discounts, rebates, and structurally lower pricing to aggressively undercut Zoetis.
And the same dynamic is bleeding into the parasiticides franchise, right? Simparica Trio, which is a massive all-in-one chewable that protects against heartworm, fleas, and ticks, has been a reliable growth engine for years.
Oh, yeah.
It posted $222 million in U.S. sales, but that represented an 8% decline year over year.
8%. Because the underlying mechanics of the U.S. pet care market have fundamentally shifted. For the last decade, this market operated like a rapidly expanding pie.
Right, the pie was always getting bigger.
Exactly. The pandemic accelerated this, with millions of households acquiring new pets and becoming highly educated on veterinary care. In that expanding market, when a new competitor launched a flea and tick pill or a novel itch medication, their massive advertising budgets actually expanded total market awareness.
So they brought new, previously unmedicated dogs into the clinic.
Precisely. So even if Zoetis lost a tiny fraction of their percentage share to the new guy, their actual slice of the pie in absolute dollars kept growing rapidly. There was enough new money flowing into the ecosystem for everyone to win.
But the era of the expanding pie is definitively over. Pet ownership rates have plateaued, and in some demographics, they are actually shrinking as the cost of living spikes.
Right. The pie is completely stagnant. So now when a rival pharmaceutical company launches a competing JK inhibitor or a new combination parasiticide, they aren't expanding the market.
No, they can't.
The only way they can gain a single dollar of revenue is by physically ripping a customer away from Zoetis. They are slashing prices to steal slices directly off of Zoetis's premium plate.
Which is brutal.
Yeah, competing on price in a soft, zero-sum market is the exact opposite environment of what a premium innovator needs.
And this zero-sum combat at the clinic level triggered the fourth and final force of the perfect storm, a brutal destocking cycle.
Destocking.
Yeah, destocking is one of those opaque Wall Street plumbing issues that constantly trips up retail investors, but it is the primary reason the revenue drop was so violent this quarter.
Let's walk through exactly how this works because it's important.
Let's do it.
Zoetis doesn't sell Epoquel directly to your local veterinarian. They sell it in massive bulk quantities to distributors, the middleman logistics companies.
Right. And these distributors manage their own working capital very tightly. In a normal Q1, these middlemen load up their warehouses. They buy massive amounts of inventory from Zoetis to get ahead of the standard spring price increases.
And they heavily stock the supply chain in anticipation of the spring and summer flea, tick, and allergy season.
Right, so they build a mountain of inventory in January and February.
Under normal conditions, yes. But this quarter, the distributors saw the real-time data from the clinics. They saw the consumer pushback, the shrinking foot traffic, and the aggressive discounting from competitors we just talked about.
Right.
They also realized that Zoetis's own promotional campaigns were significantly underperforming expectations.
So the distributors panicked.
Completely.
They looked at their warehouses, realized they were holding far too much expensive Zoetis product, and saw that consumer demand at the clinic level had basically dried up.
So what do?
They slammed the brakes on new orders. Instead of buying more product from Zoetis, the distributors chose to bleed down their existing inventory, shipping out what they already had to the clinics without restocking.
And this creates a massive bullwhip effect on the manufacturer's balance sheet. Zoetis's reported sales into the distribution channel drastically lagged the actual, albeit slowed, consumer sales out of the channel.
Right, so the destocking cycle artificially amplifies the decline, making a bad quarter look like an absolute disaster on paper.
Exactly.
So you have an exhausted, price-sensitive consumer skipping the vet visit entirely. When they do go, they're demanding cheaper competitor drugs. And because of that, the massive distributors halt their orders to clear out their warehouses.
It's just a cascade of negative events.
That is the anatomy of an 11% drop in your core domestic market right there. And to make matters worse, this pressure is accelerating the decline of their older, established cash cows.
Yeah, the transcript specifically highlighted the erosion of two foundational products, Convenia, which is a long-acting injectable antibiotic, and Cerenia, the gold standard anti-nausea medication.
Right.
For years, these drugs generated massive, reliable cash flow, but they are off patent. They are no longer part of the innovative, protected core.
They are facing generic competition. And this ties everything together. When a veterinarian knows their client is financially stressed and they're already having a difficult conversation about the high cost of blood work, that vet is highly motivated to find savings wherever possible.
Exactly. Instead of reaching for the premium brand name Convenia injection, they will reach for a cheap, generic antibiotic pill to keep the final invoice down.
The macro pressure is accelerating the loss of market share to generics.
The core premium engine is definitively stalling under the combined weight of macroeconomic reality and cutthroat competitive pricing. So this forces us to examine the corporate response. What is the leadership team actually doing about this broken engine, and what are they signaling to the market for the remainder of 2026?
Well, management was forced to revise their full year 2026 guidance downward, and the new projections are incredibly sobering.
Very.
Revenue is now projected to grow just 2% to 5% for the full year, targeting a range of $9.68 to $9.96 billion. Adjusted net income is guided to grow 2% to 6%.
I mean, a 2 to 5% growth target for a company that investors rely on for high single-digit or double-digit organic expansion is a massive deceleration.
It's huge.
But the optics of that guidance are actually far worse than they appear on the surface.
This is where we have to connect the dots back to our accounting forensics from earlier in the dive. During the Q&A portion of the call, CFO Whitney Joseph made a vital admission.
She clarified that the fiscal calendar alignment, that $100 million revenue shift we discussed, was mathematically engineered to provide a 200 to 250 basis point tailwind to the full year revenue growth rate.
Let's translate that math for everybody. 200 to 250 basis points equates to 2 to 2.5% of top line growth.
Right. They're getting a free artificial 2.5% boost to their annual growth rate just from moving numbers on a spreadsheet.
Exactly.
So if you take their official full-year guidance of 2 to 5% growth and you subtract that artificial 2.5% accounting tailwind, their actual underlying organic operational growth expectation for the year is somewhere between 0 and 2.5%.
The underlying business is essentially guided to be flat for the entire year.
Flat.
The fact that their growth projection is sitting in the low single digits, even with a massive one-time accounting injection, demonstrates just how brutal management expects the U.S. companion animal market to be for the next 9 months.
Yeah, they do not anticipate a rapid recovery in consumer spending. Not at all. And because they can no longer rely on explosive top-line revenue to satisfy Wall Street, they are executing a massive pivot in their operational strategy.
Right. They're shifting from aggressive offense to desperate defense.
The transcript outlines the launch of a comprehensive cost and productivity program. CEO Kristen Peck used classic corporate terminology, tightening discretionary spending, driving procurement efficiencies, and, quote, assessing organizational levers.
Assessing organizational levers. That is the polite, sanitized way of saying we are going to restructure divisions, halt all non-essential hiring, and quietly cut headcount wherever we can without triggering a panic.
Exactly. It is a mandate to slash operational expenses.
And the stated goal of this cost-cutting program is to ensure they can still deliver a leveraged P&L in 2026.
So let's mechanically explain what a leveraged P&L means in this defensive context.
Good idea.
In a high-growth phase, a company has high variable costs. Marketing, sales commissions, heavy distribution expenses tied directly to soaring revenue. But when revenue growth flatlines, a company with high fixed costs gets crushed.
Right.
To achieve a quote-unquote leveraged P&L in a stagnant revenue environment, management has to aggressively cut their variable and discretionary fixed costs. The goal is to mathematically force earnings to grow slightly faster than revenue.
So if revenue grows at 2%, they want to cut enough expenses so that net income still grows at 4%.
It is the ultimate defensive posture. You protect the bottom line profit margins at all costs when the top line revenue is under siege.
But there is a limit to this strategy, isn't there?
Oh, definitely.
You cannot cut your way to long-term growth, especially for a company whose entire identity is based on funding heavy research and development to discover the next blockbuster drug. Cutting costs today might protect the 2026 EPS target, but it risks starving the innovation pipeline that drives 2030 revenue.
Exactly. Which brings us to the ultimate question for you, the retail investor.
Yes.
What does this defensive posturing, this shrinking market share, and this exhausted consumer base mean for your portfolio?
Right. Like if you are holding Zoetis today, or if you are looking at the recent stock pullback and wondering if this is a buy the dip opportunity, how do you position yourself?
Synthesizing the data from this quarter, the definitive signal for the near term is bearish. The fundamental thesis has been broken.
I agree completely. It is a bearish signal. The valuation multiples for Zoetis are priced for perfection. They are priced on the assumption of limitless pricing power derived from the human-animal bond.
Right.
But this quarter provided concrete, undeniable data that consumers are pushing back. Foot traffic is declining, and cheaper competitors are successfully stealing market share at the clinic level.
Yeah, unless you are buying the stock purely for the strength of its livestock and agricultural diversification.
Which would be an incredibly strange rationale for investing in a company utterly dominated by its companion animal segment.
Extremely strange. Zoetis has officially become a show-me stock.
A show-me stock means you no longer give management the benefit of the doubt. You do not buy it on faith.
Yep.
You do not buy it just because it has a beautiful 10-year historical chart.
Yeah.
You sit on the sidelines, you protect your capital, and you demand that the company shows you the data proving the turnaround is real before you invest a single dollar.
And based on our analysis of this transcript, there are 3 specific data markers you must watch for in the upcoming quarters.
The first and most critical marker is U.S. clinic visit volumes. You need to see that negative 3% traffic trend stabilize and return to baseline growth.
Right, because until physical foot traffic at the vet clinic stops bleeding, the entire ecosystem remains under severe pressure. You cannot grow a volume-based business without volume.
Exactly. The second marker is the trajectory of their new osteoarthritis pain medication, Librela.
Ah, yes.
This drug was supposed to be the next undeniable blockbuster. It is a monthly monoclonal antibody injection for dogs suffering from arthritis. The science is incredible.
It really is.
But global sales of Librela actually declined 13% in Q1.
13%.
Yeah. Management attempted to spin this by noting that in the U.S., Librela, quote, stabilized sequentially with roughly flat growth compared to the previous quarter.
But flat sequential growth is a massive red flag for a product that is supposed to be in its explosive early stage launch phase.
Oh, totally.
A revolutionary pain medication should not be stabilizing. It should be capturing market share aggressively month over month.
Exactly. You need to see Librela return to aggressive quarter-over-quarter growth before you can trust that their vaunted innovation engine is actually capable of overcoming consumer price sensitivity.
Right. If pet owners are refusing to pay for premium arthritis relief, the core thesis is dead.
Yep.
And the third marker is the competitive discounting in the dermatology market. You need to monitor the pricing behavior of rival JK inhibitors. You must see the aggressive price cuts from competitors cool off. Or alternatively, you need to see Zoetis prove that their point-of-sale loyalty and rebate programs can successfully defend Apoquel's market share without permanently destroying their own profit margins.
So wait for the data. Stay out of the trade until the metrics prove the core engine is running again. Let management prove they can navigate a stagnant pie before you pay a premium for a slice of it.
It requires discipline, but ignoring the macro headwinds in a premium-priced asset is a recipe for capital destruction.
It really is. So I want to leave you with a broader macroeconomic question to mull over as you analyze your portfolio this week, because the implications of this earnings call extend far beyond just one ticker symbol.
Oh, absolutely.
We have established that everyday middle-class consumers are suddenly willing to swap out premium brand name blockbusters for cheaper generic alternatives to treat the pets they view as family members.
Right. It represents a fundamental psychological shift in consumer behavior that Wall Street models simply haven't priced in yet.
Right. The question you must ask yourself is this. Is this pushback just a temporary blip caused by transient inflation fatigue? Will consumers go right back to buying the most expensive drugs the moment interest rates drop and grocery bills stabilize? Or has the golden era of unquestioned, limitless pricing power in the animal health sector officially come to an end?
That's the million-dollar question.
Because if the rubber band is permanently snapped, the premium valuation multiples across this entire sector are going to have to violently contract to reflect a much harsher, highly competitive reality.
It is a systemic risk that every investor in the healthcare and pet care space must confront immediately.
Absolutely. Keep a very close eye on those clinic volume numbers next quarter. Thank you for joining this Stock Tickers deep dive into Zoetis' Q1 results. Remember, ignore the flashy headlines, do the accounting forensics, stay data focused, and trade smart. See you next time.